Well, hello and welcome to Trading Blows, a busy show ahead. On the show this week, we discuss the Japanese yen, whether there was not intervention and what might lie ahead, how long the dollar's winning streak can continue, whether we've passed peak pessimism in terms of China, and we'll also have a look to everyone's favourite data release, Friday's non-farm payrolls number. Without further ado, let's get into the show. So, plenty to discuss on the show this week. Joining me on the panel, Ryan Paisey, the founder of PiQ Suite, Adam Linton, the head of the European desk over at Newsquawk, and Arno Venter from down in South Africa, and myself from home this week because the militant train drivers have decided to go on strike again. As always, the panelists will score points for a great response. They'll have the threat of points being chalked off looming over them if a dispute is raised over their answer, and the better the answer they give, the more points they will score. With all of that said and done, let's get into the first round. So, I want to get through the first round quite quickly, actually, because I've already had to rip up my script for this once, given the issues that we had with the yen yesterday, and don't really want to have to do that a second time. So, Adam, let's start with you, because I believe you were squawking this as it happened, if I remember correctly. What on earth do we think's going on with the yen? 150 to 147 in the blink of an eye yesterday afternoon. Was it intervention? Was it something else? What's going on? Clear it up for us, mate.
Well, first of all, I'd just like to raise the issue which has been brought up on the desk, how disgusted one of my employees is over your title for your LinkedIn note this morning of yen-tervention.
Oh, he did it.
Yeah. It's,
minus points. Points. Oh, God.
You're not popular over at Newsquawk Towers at the moment, I can put it that way.
Was I ever?
Yeah, well, that's true. That's true.
You imagine if the FT would have done something like that, he would have exploded.
Yeah, exactly. He'd have threatened to cancel his subscription, which he doesn't use.
Well, exactly. Right, now my little slap on the wrist is out the way.
Yeah. Okay, so as you said, I mean, we saw this violent move yesterday, which kind of coincided with that, pretty hawkish JOLTS report. And, obviously intervention was being bound around. And as you correctly said, it's suspected at the moment. We don't know if it has actually taken place. Japanese officials have been relatively mum on it, which, historically they have come out and said when there has been intervention. I think the first one they did in September last year, they followed it up by saying that they did. There's a weird Reuters piece earlier, which I didn't quite fully understand, and they're suggesting at the moment there's no actual physical evidence that they have intervened. But, whether they have or, whether it was a case they were, what's called checking rates, which, is something they do in the run-up to intervention. We don't necessarily know. All we know is that at the moment we saw this violent move in dollar yen, and, someone in the market has decided that is the line in the sand for the pair. We've talked about this quite a few times before, and, ultimately, the dollar yen move has reflected fundamentals. We've seen a big divergence in policy between the Fed, between the BOJ, and it's been one-way traffic ever since. We've seen some of the Japanese officials try and talk the Japanese yen up, talk dollar yen down. It's been absolutely pointless because there hasn't been anything for the BOJ to really kind of turn the tide for the pair. So it looks like they've defended this 150 level. And, in terms of kind of the sustainedness of that move, I think we got down towards 147.30-ish yesterday. Yeah. We're now back. We've spent a bulk of the session up about 149-ish. So we're only just a point shy of it. And, I was reading earlier that when they intervened between September last year and October, I think the dollar yen still moved from about 146 to, I think it was about 152-ish. So anyone that's looking for dollar yen to be line in the sand at 150, they might be relatively that's not necessarily going to be the case based on history. I've been quite consistent that in order to turn the tide or at least get bullish the yen, you have to see something from the BOJ and more than just verbal physical intervention, because physical intervention by definition can't go on forever. And I think, I don't necessarily see what the next inflection point is other than potentially the October BOJ meeting at the end of the month. And if, they do begin to kind of acknowledge their goals have been met and have made progress, then potentially yes. But, I don't think that's necessarily where we're really at for the BOJ at the moment. And, obviously I'm going to take a point for this because this was your work earlier, but you had that JPM, there's that JPM 3 points thing, wasn't there, earlier, suggesting that it isn't, the right market for them to be doing in this. I think, they noted dip buying, and it's inconsistent with their bond buying operations as well. So, yeah, we've got up to 150, but I don't think it's necessarily going to be a firm line in the sand that some people think it might be.
Well, incredibly comprehensive there, mate. And you somewhat redeemed yourself after moaning about my content earlier on. So well done there. Ryan.
He had nothing to redeem about. You were bang out of order.
I was just going to say, Ryan, welcome back. You've been away for a month gallivanting around the States. It's good to have you back, mate.
Thanks.
What are your thoughts on what's going on then? Are you in agreement with Adam that this is kind of have your cake and eat it policy making almost?
Yeah, pretty much. Just to elaborate on from what one of my dearest friends, Adam, said regarding how that they can kind of the data which
I've never met him, by the way. This is
that's live. He's tucked me into bed many times when I'm little spoon. But yeah, so this data that people were looking at to see if there was intervention, it's the money market conditions forecast. Unfortunately, obviously that's a bit cloak and dagger at the best of times. But what appears that most people are forgetting is it was because the move or the intervention was at 11 p.m. Japanese time. We wouldn't see that data today anyway. So there's so many people that are wasting too much time looking at these money market conditions that are published for tomorrow, and it is rubbish because the data wouldn't show until tomorrow's data. So look, even though they've kind of said, "Oh yeah, it wasn't us, Gov," I think it's pretty obvious. Your bets would be on it was the Bank of Japan.
We'll know by the end of the month, won't it? Because they release their official data. Yeah. I think it's the last working day of every month. I think they do, don't they?
I think there's a chance that maybe it's been done for the Ministry of Finance, the MOF. Maybe they've circumvented the Bank of Japan somehow, and maybe there's something they've done that technically it wasn't the Bank of Japan just coming in and smashing the market. Regardless of what's happened, in terms of finessing your order, it's just fucking what an awful way to kind of protect the level. At least with the Swiss bank, right? Swiss National Bank, when they were holding a peg, they just left it on the bid or work the offer, just keep it there. Well, I'm there for a gazillion lots. Just keep it at me, it's fine. But Bank of Japan, they say that this is their level, and rather than protect 150. They weren't protecting 150. They were using 150 to be hit, and then they were just triggering a market order that sell. By the looks of it, they didn't even have a target to sell down to. They were like, okay, well, we're going to sell X gazillion yen at market whenever our levels hit. Which, these guys are meant to at least understand how financial markets work or forex markets work. It's the worst you've ever seen in your life. So, if any of them like watching, I wouldn't mind a bit of extra beer money and some beer tokens. I'll even buy a Acai beer if it makes you happy. But give the order to me. Forgetting all of that though, let's move on. So a little rant over, one of many today. I don't. If it was them, wasn't them, doesn't really matter. I think we'll see 155 by Christmas. Trend is the friend, not to them obviously, but it's if, as Adam said, it might be you, Michael, as well. They obviously haven't got a strict peg, and it's obviously a region, which just means the market's going to keep pushing it and pushing it and pushing it. And the market wants to go higher. So especially if you're going to fill your orders like that, it's going to keep going higher, and it's just going to give you better places to buy it.
Yeah, absolutely. And like you say, the market is now probably going to try and test the authorities' mettle a little bit. Arno, let's go down to you. Are you kind of in agreement with that view that the authorities over in Japan are, whether they're intervening or not, checking rates, jawboning, whatever they're doing, ultimately, are they just fighting a losing battle with this one, given what's going on with treasuries, given what the lack of any urgency from the BOJ and all the other factors in the mix as well?
Yeah, definitely, mate. I mean, if you take a look at last year's interventions, as was the case last year, it's not sustainable as long as you have the current yield dynamics that's in play. When you have one bank doing ultra easy monetary policy, keeping rates capped at as close to zero as they can, while other banks are hiking above 5%, you're pushing on a string in terms of these interventions. You're just like, they're basically just buying themselves some time. I think what they are hoping for is now, which is that, the dollar US data just starts to tumble. And obviously that gives them an out, because that's really what happened last year, right? Remember that they intervened in September, they intervened in October. The only reason why that second or third intervention last year was successful is because the dollar lost ground. It peaked out with that peak inflation theme.
This is it. So the intervention wasn't successful.
No, not at all.
The timing was lucky. Let's be honest.
Yeah, exactly. It was
so successful interventions.
That's it. And that's where we are now with the data. I think they're sitting there just like the market saying, hey, let's get some bad data. Let's hope for bad data, because that's going to push the dollar lower and it does our work for us. So I think the saving grace for the
going to be tuning in for non-farm payrolls then, is that what you're saying?
Say again?
The whole of Japan's going to be tuning into non-farm payrolls on Friday. Then.
Well, at least the MOF will, They'll be sitting there saying, okay, we probably need to do something here if it's hot. But yeah, I think, the saving grace for the yen would be if we see not just one, but a string of very bad US economic data, which basically just gives us a little bit of a local top in the dollar and yields. Unless that happens, the markets will just keep on testing the MOF and the BOJ, just like they did last year. So unless yields in the US goes down, the pressure will remain on the Japanese yen. That doesn't mean that I want to, I want to sell the yen here, though. I think one thing that they have done or accomplish with these types of moves is it does make those yen sellers a little bit more cautious, I would say. Doesn't mean that it can't go higher from here. The thing that we've said this so many times on the program, you can't short dollar yen in the hopes of intervention. There's a couple of players who got short 145, 146, 147. They are still underwater, by the way, with those trades, even after this type of intervention. So the trend, like Ryan said, the trend is your friend right now. Unless yields in the US goes down, it's just going to be that pushing against the string. But maybe they get lucky like last year and, the dollar goes down, which gives them an out.
Maybe. Well, Arno, I'll tell you what, why don't you hold that thought, because we're going to get onto the dollar in the second round.
Just quickly, though, just on this, if the dollar does pull back, and yields relax and we do see all that coming, if you do want to trade on the dollar yen, I'll be using that as an opportunity to buy dollar yen. It's not, I think longer term, medium to longer term, I think, there's no reason why this time next year we're not talking at like 165, 160. It's not going to turn around.
Especially if the data stays solid. If this US exceptionalism bid holds up, then there's no reason for that trend to change.
But not only that, just in terms of, the state of Japan as a whole, okay, right, so your economic data might be improving or whatever, but, we go back to demographics and stuff, they're fucked.
Yeah.
Well, that's a nice positive note on which to end that round, isn't it?
It's a technical term.
It's a technical term. Query analysis with Ryan Paisey.
Let us know when your Nobel Prize turns up, Ryan.
We could be waiting a long time for that. Right, let's move on, shall we, to the dollar. Right, Arno, considering you brought this up, you may as well take it away. The dollar is in, a 12th week now of gains, if it manages to close out this week in the green. How much longer can this go on for, mate?
Again, comes back to the data. The one thing that can stop us here is if the data starts turning around. The better data in the US, especially when everybody else has done so bad, like China and Europe, I think that's been a key driver for dollar strength. If you combine that with the markets getting on board finally, with a higher for longer view, that's all been a key driver. So if the better data has been a key driver for that, I think that the first place that I would be looking for some possible downside would be if the data comes in weak. I mean, today we had the ADP a little bit earlier. We'll touch on that, I'm sure, when we talk about NFP. That came in at 89,000, well below the market's expectations, and the dollar is pushing lower. ADP isn't a massive data point, but when it reacts like this, it shows you that the markets maybe have gotten a little bit too aggressive, too quick when it comes to the dollar right now. Now, if you go through sell-side research over the last couple of days, suddenly everybody's a bull, right? A dollar bull. Everybody's bullish. It's euro dollar parity. It's down to 102. It's all of these aggressive takes. And when everybody gets bullish, while they weren't bullish, that normally gets me a little bit cautious. Look, doesn't mean it can't go higher from here. But again, I wouldn't really like to chase it higher from these levels. I just don't think the risk reward is attractive to do so. If we get a decent dip, obviously that could be good for buying opportunities. At these levels with 11 weeks of gains, I would prefer to be a short-term bear, like we said last week, if the data surprises meaningfully to the downside. Because when you look at positioning, it seems like the markets have gotten very aggressive, looking back over the last 52 weeks or so. So if we do see a bit of a data divergence coming into play, obviously ISM services coming up later, NFP coming up on Friday, we'll touch on that. If the data comes in weak, I would expect a lot more reaction to the downside for the dollar on bad data right now compared to upside for the dollar on good data, just because it's priced in so much already. That doesn't mean it can't go higher on good data. It just means that, do you really want to chase it? If you've been long, there's probably a lot of players out there who on good data will rather use these opportunities for profit taking as opposed to adding positions to that trade, because it is looking a little bit stretched. So as long as the data remains intact, it could remain, intact in this trend, but eventually the data is going to start looking a little bit weaker. And, that's where I think the short-term opportunities for traders would be right now.
Yeah, I think I would tend to agree with that. It's definitely at the point now where that balance of risks is much more tilted towards a bigger reaction on a downside surprise than it is an upside surprise, I think. Ryan, are you thinking along similar lines, or are you still thinking that the dollar's got more left in the tank?
I hate the concept of trying to pick tops and bottoms with a passion, mainly because it's cost me so much money in the past. You look at it, you try and be neutral, you try and come into it without a view, and you say, well, but then you see the chart and you're like, yeah, it's done too much. But obviously you can't keep doing that. I think, as my dear friend Arno, who hasn't tucked me into bed yet, but he will do one day, as he mentioned, it's all data. I think, as it's not just in terms of currency and forex, and not in terms of dollar, but in terms of pretty much most markets that you will be trading, 10-year yields are like the philosopher's stone for pretty much everything right now. You need to know what I think it was Buffett that said, if I could be told one piece of information 5 years out, what would it was asked the question, if you could be told one piece of information 5 years out, what would it be? And he said, always 10-year yields, because it's your in effect your risk-free benchmark. And that's driving so much at the moment, and especially as we're getting up 5% and stuff. So there's so many like psychological areas that are coming into play. I don't have a clue, to be quite frank. I'm struggling to see why yields would stop here. Not mainly, maybe even not for a fundamental reason, but there seems to be so much drive now, just wanting to push through and almost to see where they can go. We see that maybe not so much in bond markets, because they're technically are meant to be more kind of realistic markets and more fundamentally driven. But we do see it in energy markets and oil markets and metals markets often, where when we're hitting these extreme levels in terms of price action and stuff, we will go an extra leg, because market participants and people moving the market just want to find out, okay, well, look, it took us a while to get here, but this turn the screws and really find where there's a lot of pain out there. And it feels to me that rates and dollar, well, with this, just combine the two things, right? 10-year yields and USD, it feels like we're nudging that extreme pains positioning, which is why I believe, gun to my head, I reckon we would exceed that and just really have a little flush out. Because let's be honest, although everyone's screaming about 10-year yields at 5%, oh god, what's going to go on? It's been quite an organized move. We've not seen any flushing or anything like that. And when I say a flush, I mean an aggressive flush. When you're really cranking the hand, or a proper aggressive flush going on. I thought that was quite funny, just me. All right. Sorry. So look, I personally, if you need to have a trade on, I would be looking from small pullbacks to join the trend. I definitely wouldn't be looking to fade it. That's pretty much all I've got. Keep an eye on the 10-year yield. That is the game. But you could say that for pretty much every asset out there at the moment.
You definitely could, but I think, you know, more so now than ever. If you're not,
Yeah,
more so now than normal. If you're not watching the 10-year yield, then, you know, what on earth?
Yeah, like quiet markets, who gives a fuck? But but yeah, when it's like this, it's like you do need to have one. You know, I recommend even a retail trader just know where your 10-year yields are.
Yeah,
absolutely. I would strongly agree with that, especially when you're seeing, you know, I mean, I'm just looking at the charts here, moves of, you know, 13, 15 basis point swings, high to low on a daily basis. You've got to be on top of it.
Yeah, like the move is so the volatility index for bonds, the move index is like 14-month high or something like that. I think I read. I might be wrong, but it's highest since kind of language.
Yeah,
which we're seeing a lot.
I mean, if I had a pound every time this week, I'd read a highest since headline.
I've not had a drink.
I wouldn't be doing this show, would I? Adam, what are your thoughts on the dollar? What are the risks on either side of the equation here? I mean, there's been a lot of talk about how crowded things are starting to become. Is that something that you're considering as well?
I think, you know, in terms of the way I kind of see this dollar move, like, you know, for the past few weeks, I think it's kind of been more, you know, as Ryan and Arno mentioned, it's basically been this yield-driven move. And, you know, from a monetary policy perspective, since the, you know, the slightly more hawkish than people had expected FOMC meeting a few weeks ago, there's not really been too much in the way of data to be able to kind of get bearish. I think, you know, and it's been quite the opposite. We saw that JOLTS figure yesterday, which is clearly, you know, quite a bit above expectations. I think
it gave the market a bit of a jolt, didn't it?
Oh. You could say that. You could. I wouldn't, but, you know, that says more.
Line out.
Yeah.
That's like intervention type of stuff.
Yeah, exactly.
Ridiculous behaviour. He'll be tweeting words like geezer in a minute as well. Really.
But, yeah, I think, you know, I think we'll know a lot more about this dollar move post 1:30 p.m. on Friday. I think, you know, this is probably, you know, we'll touch on later, one of the more important non-farm payrolls releases we're going to see. And I think the way that I kind of see it is because the market consistently throughout this year has wanted to get more dovish than the Fed has been suggesting that. You know, we saw the Fed, they're still leaving one more rate hike on the table for this year, and they took some rate cuts off the table for next year. And I think, you know, if we get a dovish NFP report, I think the market will potentially, you know, jump on that more than it would, as Arno said, a more hawkish report. I think, you know, there's definitely a symmetry around the dollar index at the moment. In terms of kind of how we progress through the quarter, I think the signal is actually quite hard to read at the moment, because I think, you know, yes, it's obvious that US growth will slow, but like I said, I think as the last time I was on, it's, you know, it's how it slows relative to everything else. If, you know, the US is turning, but then, you know, Europe's, you know, not doing well, China's not doing well, then it becomes more of like a global growth slowdown. And then depending on what kind of risk aversion that prompts, you know, we could see the dollar actually supported in an environment. So therefore, you know, I don't think the signals for the dollar are particularly clear. And I think, you know, from, you know, going back to yields from what Ryan was saying, I think in the short term, you know, the Fed is, you know, carrying a lot of power here. But I think over the, you know, the medium term and going forward, I think one thing that needs not to be overlooked is, you know, the fiscal element of what's going on in the US. You know, we've seen these like rolling shutdown, you know, debates and stuff, but they're getting increasingly, you know, heated over like the fiscal sustainability in the US. And we've seen credit rating agencies take a lot more of a dim view. And therefore, you know, if yields, you know, have to reach to a high level because of this, then it's hard to kind of argue against the dollar in that environment, particularly, you know, if you take a product like, you know, the DXY, which we've talked about, which is basically 60% the euro. In the short term, I don't see, you know, in my opinion, I don't think there's really going to be anything material to kind of really, you know, get bullish about the euro. It might stop the rot, but October they're going to hold. We know that. And it's hard to see anything that's going to derail that. We've talked about the Japanese yen. At best, you know, they can hope to stop the rot unless the BOJ gets materially hawkish. But as I've said before, if they are to go on this tightening campaign, it's going to be when the rest of the world is either paused or cutting. And I just don't see, you know, the BOJ being the hawkish outlier. So that's kind of the way I'm kind of framing the dollar at the moment. I think, you know, don't buy too much into this US slowdown story, because FX is all relative, and you need some sort of more constructive, you know, outlook on, Japan, Europe, and China?
No, absolutely. And
sorry, can I, as normal, can I just interrupt?
Well, you have now, so.
Adam skirted a very important point that, I feel a bit silly that I didn't mention it. Something that we're not talking about is the dramatic rise of event risk in US dollar right now. In terms of, McCarthy's now been booted. They've only got spending for 45 days. So when that comes back, there's a very high chance that the person that's the speaker, they're not going to be pro the kind of the measures that McCarthy took, which allowed the vote to get through. So I know Goldman Sachs was saying there was like a 90% chance of a shutdown this time, but obviously McCarthy, basically became a Democrat for 24 hours. That's not going to happen yet. So I'm not going to put a number on it, but my money would be on, so better than an even money shot, that in 40 days time, whatever it is now, so just before Christmas, coincidentally, I would be shocked if things are staying like they are, that there won't be a shutdown. And then also your rating agencies come into play.
Sorry, you go.
Yeah, go on.
I think, because we historically downplayed, the importances of shutdowns and the likelihood of them occurring.
Another shutdown.
I think the thing that feels, it feels different this time is that next year is the US presidential election. A big part of the holdup that we've seen over the past few weeks has been this funding to Ukraine. Whoever the Republican presidential candidate, they're most likely going to be very much, at least for curtailing back spending on Ukraine, which is, is going to be the main dividing line in Congress. It's only going to get, it's going to be existential for either party heading into next year.
I think you nailed it with bringing up the fact that there's also an election going on. So I don't think it even matters what the funding is for. It's just being used as if Republicans can get government shut down for whatever reason, because a Democrat is in power, it's for them, it's a vote winner. When just before Christmas or a week before Christmas or whatever it is, I honestly believe that we'll get a shutdown. And in itself doesn't really do much unless it's a prolonged shutdown, but it does bring the ratings agencies into play, and that's where we'll get the event risk for the dollar. Because we've got to remember as well that depends on what moves the ratings agencies do. There's a lot of big, huge $1 trillion pension funds out there that are mandated by certain criteria what they can and can't invest in. Now, if there's significant changes by rating agencies, that may impact their mandated investments, which means they are forced to sell or buy or whatever. And this is where you get these all kind of knock-on effects. But however, even though I'm convinced that there's going to be a shutdown if things stay as they are, a shutdown is not a default. And please remember that, because they are two different things.
Absolutely. One other thing that's worth bearing in mind is not just, and this is something that you yourself, Ryan, skirted around the edges of, is not just, is there a shutdown or not? What are the chances of it being prolonged? Because I would argue, if it is a new speaker, whoever that's going to be, I'm not sure anyone's sure just yet, but a new speaker is very unlikely to fall on their sword and do the kind of 24-hour acting as a Democrat thing that McCarthy did over the weekend.
Exactly.
So, how do you then get a deal, and how does that brinkmanship end up resolving itself?
Also, you could, because it is going to be over Christmas, having a shutdown for 3 weeks over Christmas and New Year, bothered, it's probably a good thing for them. You know what I mean? It's like, I'm feeling a little bit ill today. I'm not going to come in between Christmas and New Year.
As you pointed out, it's incredible how lucky the lawmakers are that even though federal employees don't get paid, they do. They're very lucky.
What are the chances of that, eh?
Hell freezes over and they're still getting paid. Don't worry about that, son.
Right. Well, before Ryan says something that means he's not allowed to go back to the US, let's get on to the third round. Right. Well, everyone's heard far too much of us three over the last few minutes. Arno, let's get back to you. What are your thoughts on what's going on in China of late? We had, obviously, the latest PMIs out over the weekend. The official PMIs painted a bit of a rosier picture. The private surveys, not quite so much. Are you thinking that we might have got past this peak pessimism point just yet?
I do think so, man. I mean, we spoke about this, last week as well. I do think Q4 has a higher probability that we see a slightly more constructive view for China. There's obviously risks still involved in the property sector. Nobody's going to forget that, but it does seem like we are, very close to a peak pessimism situation right now. If you consider all of the policies and stimulus measures they introduced just throughout Q2 and Q3, some of that should start to make its way into the economy. I would expect in Q4, in Q1 going into next year. The thing about the recent data is that even though the private survey was a little bit more negative, it was the first positive NBS manufacturing print we had, I think, since March earlier this year. So it is showing a little bit of upside, but there's also a couple of other data points. I mean, industrial profits, I think, printed close to 20% up year over year, which was good. Goldman was out with some pretty cool data as well, showing that traffic congestion, was above 2022 and 2029 levels heading into Q4. Subway passenger volumes, so I think above pre-COVID levels. Freight volumes with ships going out started to pick up as well going into Q4. So I do think Q4, there's a higher probability that we have a more constructive view for China, even if it's just, a little bit of a bounce. Now, the interesting thing about that, is going into Q4, if we do start to see, we spoke about this with the prior point, if we do start to see US data starting to just soften a little bit going into the fourth quarter, what would really throw the markets out of sync completely, now that everybody is so super bearish on China and so very, very bearish on the euro, the euro, is in quite the state because the data has been absolutely horrendous. But if China starts to see a slightly better Q4, which is right now my expectation, while the US might be seeing a slightly, less solid Q4, that could be the perfect recipe for some very good mean reversion plays in the FX space. I'm not excited to be buying the euro right now or buying the Aussie right now versus the dollar, but they do look cheap. And if we do start to see China looking slightly better on the data side, it's like we've spoke about this before. It's like keeping a inflatable ball under the water. You keep the pressure. If you just release your hand, it's going to shoot up. And I think that's the risks where we're at right now when it comes to China. I think if the data can just start surprising to the upside, I think the markets will react far more positive to that than they've been reacting to the negative data. The way that I'm expressing that right now is I've taken long positions in the Aussie CAD. The reason why I like the Aussie CAD higher here is, again, peak China pessimism, which I think is in play. And even though I am bullish something like WTI right now, I do think that after, a 40% gain over the last 3 months, that maybe WTI moves a little bit more range bound over the next couple of weeks. And if China does start to see a bit of a recovery, I think that could open up a really good commodity differential between, with copper and WTI, obviously being positive for the Aussie CAD. On the data side as well, things have been holding up pretty well in Australia. So that would be my preferred way to express that, not necessarily, long Aussie versus the US or Euro versus the US. I think the miners play would be the best way to do that, from a miner pair perspective. Aussie CAD would be my play.
I'm glad you clarified that by saying minor pairs, because for a minute I thought you meant miners as in, pickaxes and shovels.
When I said it, I thought, let me just clarify that for a second. Yeah.
I'm glad you did clarify that one, mate.
The miners in play that I was getting a little bit worried about.
Oh, God. No. Right. Ryan, we may as well go to you. It's interesting. We've got asymmetric risk probably to the downside in the US, perhaps asymmetric risk to the upside in China. I was going to say Canada then, but in China. How are you viewing the situation over in Asia at the moment?
I don't think, I'm struggling to get all optimistic. I'm not really seeing this, if we're only relying on like the official data, then what we're playing at, because we all know that's bollocks. But just touching what Arno said about EU, I think, funny enough, half my notes for this bit are on the EU, ironically, because I think that is going to be that we could see more action in the EU markets and the EU as a whole based on what happens with China. World biggest trading bloc, accounts for 16% of world imports exports. At the moment, they are torn between the US and China. Right, they need to appease one. China and the US, as much as we're seeing like lovey-dovey language occasionally, they're in terms of what policies are going through, they're getting more and more further apart. The EU are going to be forced at some point to make a decision, which way they're going to lean. In my opinion, the EU and more importantly, European firms need to be prepared to take or prepared for extreme scenarios, where the US is almost forcing them to leave China. I really think that's in play. I think that, I know it's not exactly the answers or the topics that we're meant to be discussing this subject, but it's China related. So there you go. You're going to give me.
And you're getting points for it anyway, so don't know too much.
So that's that. But in terms of just China itself, I think something to be aware of, again, ignoring the bullshit data, which is crap. Policy that they've done, all fart no poo, another technical term for you. They've said a lot, but in terms of money actually hitting markets, there's very little. We're not seeing much at all. We had data. If we want to look at data, the good data that's come out, house prices increased, right? Oh, great. Headline, awesome headline. One is, it's Chinese data, so pinch of salt or pinch of sesame pepper, if you will. But this rise in property prices was a 0.05%. Do me a favor. Like this, if that's your BS data point, that's good. How bad is it really? So ignore that. Something that's something else to have on the radar with China, Taiwan elections in January. There's going to be a load of headlines, a load of silly madness going on with that. So have that on your radar, definitely. Speaking of radars, we're going to see a lot more flights going into the ADZ and stuff like that from Chinese Air Force. Make sure you keep an eye on what's going on with the Taiwanese elections. You lose money very quickly by trying to second guess either what's really going on in China or what the next policy move will be in China, because there's people get paid. There's services out there for like investment, like companies and funds and stuff, that get paid, that charge hundreds of thousands of dollars a year, and they're as certain as I am. In which case, they do not know, right? So. It's far too easy to get bogged down and overthink all these things. For instance, like today, Citi raised its China 2023 GDP prediction from 4.7% to 5%. It sounds great until you realize what they're actually predicting. All they're doing is they're forecasting what they believe the Chinese government lie is going to be, because we know the numbers are made up. So they're not saying, oh, we think the number's 5%, because they're basically trying to forecast what the official data will be for the 2003 GDP, correct? When we know that's made up. So this forecast of the 2023 GDP is a forecast of what the bullshit is going to be. It's madness. Just stay away from it. Keep an eye on it. If you want to trade risk and events, especially the Taiwanese election, keep an eye on that. Be more concerned about the Chinese impacts to Europe based on the infighting between them and the US. That's it.
No, absolutely. It is. I mean, forecasting economic data is a little bit of a mug's game anyway, although we're all going to try and do it with the payrolls print in a second. Forecasting a made-up data point is just complete folly. Mr. Linton, what's your thinking around the whole thing? Particularly, I mean, Ryan touched on it in some depth there, the potential spillover effects, not just on the negative side, but maybe even on the positive side as well. Obviously, one of the big pessimistic drivers of the euro earlier in the year was lack of demand from China. So are we thinking that might start to come back a little bit?
Yeah, I mean, I think in the very early onset of the year, when we had the China reopening, it was very much, allied with the declines we saw in gas prices. That was very much part of the feel-good story for the Eurozone, if you can kind of call it that. And then since then, as China slowed down, a lot of the data for the Eurozone has been pretty grim, particularly if you're looking at Germany. So therefore, if you do see a bottoming out or, peak pessimism or pickup in China, however you want to frame it, then naturally this should have some follow through for Eurozone to some extent. Particularly given that it's more economically, Eurozone's more economically tied to China than it is the US. I just kind of question how much kind of follow through there's necessarily going to be. I think, the traditional kind of relationship between the Eurozone and China is always framed via, German automakers. But, that's, I think, a relationship that's kind of breaking down to some extent. I think, is kind of going the other way. China's trying to penetrate European markets now, We've seen, the Eurozone accused China of dumping cheap EVs in the market. So I don't think it's necessarily going to be a panacea for the Eurozone because, like Arno said, we might see peak pessimism, but actual bullish China story, something equivalent to what we saw in the start of the year, I think is unlikely because that was them reopening their economy after it being in lockdown. I don't see where this, incremental bullish catalyst is going to be for the Chinese economy because, there's also a geopolitical angle as well between the Eurozone and China. And then also it's an election year in the US. So therefore, the one thing that Republicans and Democrats can agree on is they don't like China a great deal. So they're going to be putting pressure on the Eurozone as well. So seeing how that one kind of plays out could, muddy the waters for the Eurozone. But also as well, like even if China does pick up, it doesn't mean, everything back home for the Eurozone is going to be rosy. It's got its own domestic issues to contend with. And even if the ECB does stand pat on rates at the end of this month, we know that policy will be getting incrementally tighter as, the monetary transmission lag, that kind of filters through. Do they potentially, halt reinvestments for their PEP program? So I think, in a world, a couple of years ago where policy was kind of constant, Eurozone and China, the kind of the traffic was more one way from Eurozone to China. I think, pickup in China could be favourable for the Eurozone, but I don't necessarily think that's as much the case anymore. And I think there are issues closer to home for the Eurozone, which kind of muddy the waters.
Yeah, absolutely. It's interesting you mention policy getting tighter next year because one of the Fed speakers mentioned that yesterday. I think it may have been Bostic. And I think that's probably the first time a policymaker has actually alluded to that fact properly, that as inflation comes down, the real policy stance is going to become more restrictive as we move into next year. And it'll be interesting how you couple that with the lagged effects of the tightening coming through.
And that's something that's something that companies can't, increase in real rates, companies can't pass that on to consumers. So, we kind of saw the early stage of the cycle when real rates, were negative. There's a lot an easier corporate environment for people to operate in. I think people need to be aware that it's going to get increasingly tougher. And I think watching things, such as prices paid and price received, or, different, survey data, I think, that's going to be quite telling over the coming months.
Absolutely.
Just to quickly add a bit more flesh to the bones that Adam said regarding China improving their situation and then obviously moving into European markets and could adversely affect Europe. The biggest loser of this is Germany. Germany, very high, high grade or whatever, very advanced industrial exporter to China. China are doing a lot more of that. They've onshored a lot of that, and they're now exporting cars, for instance, and stuff like that. Germany, as we know, are in a massive, a big old pile of shit at the moment. That's only if we start seeing an increase of this and we start seeing more Chinese exports, that is bad news for Germany. We see Chinese exports as a good thing for the global economy. We need to remember and have at the back of the mind that Germany were a big exporter to China. So if China are exporting these higher quality goods, especially the ones that they used to import from Germany, it means that Germany aren't exporting as much to China, which was one of their major trading partners. So add it to the list of things of why Germany are in a very, very tight spot.
Absolutely. Right. Well, with that said and done, let's get on to the last round of the show. So it is, of course, the first week of the new month, and that means that we do have the latest US job report coming up on Friday. Ryan, I'm going to start with you because I feel like there's a moan and a rant brewing here.
Well, funny enough, so I've dictated my portion of this show to talking about something other than NFP because I really could not give a shit about NFP. It's just look, check the revisions. That's what I'm going to say. What I'm going to spend my time talking about, if that's okay with you, is Ryan's rant.
Oh God!
Right, we're seeing a lot at the moment of people on social media and whatever using phrases like "the market hasn't traded like this since the financial crisis" or internet boom like the 2001 and stuff. Right, the majority of the people saying this, sometimes they weren't even born at this point. They most definitely weren't trading at that moment. Right? If anyone is saying the market hasn't traded like this since and they weren't trading markets at remove them, delete them, dig them out, chuck them in the sea. I mean, mate, just really winding my tits, right, doing my tits in, to be honest. And I'm like, I'm trying to be a better person, you know, change, you know, the Twitter account's changed to @PiQ Suite. I'm meant to be more professional. I'm not trying to dig people out. So I'm asking everyone else, dig them out for me, please, because it's winding me up. There you go. And NFP, I really don't care.
Right, well that covers that one, and to avoid Ryan getting in trouble, other people need to do his dirty work for him. Adam, let's get a quote-unquote proper non-farm payroll preview.
I bet you're right, mate. I bet you're completely right. Yeah.
I was going to say, you know, am I meant to answer the question or go on a rant about, you know, traffic wardens or something? I don't know.
Oh, I mean, at this point,
it's to share. This is my therapy.
Yeah. You know, I mean, in terms of recent indicators, I think, you know, we saw ADP today, as Arno says, 89,000, but let's not do the same thing we do every single month. And then, you know, say, oh, ADP is pointing towards a softer number. It comes out, you know, way higher than 135. Like, oh, yeah, ADP is terrible, isn't it, for forecasting? We do the same thing every single month. And it's it's basically emblematic of the fact that most data in the market is garbage, but the market just needs kind of something to go off, so it'll go with it, and then just, you know, kind of downplay the importance after. But
you're having a moan now as well.
I quite like this.
Oh no, yes, yeah.
Let go. I'm loving this. I'm recording it.
I think ultimately, you know, and the jolts was the key one here. The market's clearly more tighter than you think it would be at this stage of the cycle. That jolts figure, whether, you know, that's a one-off or not, I don't necessarily know. But I think when you look at the employment component of ISM early in the week, and then you think that jobless claims still just lingering above 200,000, it's not really kind of seen any material spike higher. I think, you know, as I mentioned earlier, this non-farm payrolls print, I think this is one of the most important ones in a while. And I frame that, as I said, in the context earlier of the market just wants to get dovish against the Fed. So if we see a dovish report here, I think, you know, like Arno said, there's a real asymmetry here. I think it just wants to kind of price out the last hike for 2023 and get more aggressive on rate cuts when it comes to 2024. I think, you know, in terms of what I'm looking out for in the release, I think the unemployment rate, I think, could actually potentially be more interesting in the headline. We saw that jumped from, I think it's 3.5 to 3.8% last month. The Fed's looking for 4.1% end of year. I think the consensus is looking for 3.7%, but there's kind of like a time value element here whereby we're getting quite close to the end of the year now. And the longer that stays, you know, away from the Fed's kind of targets, the more likelihood you could potentially see pricing for that, you know, 2023 rate hike. And I don't think, you know, an extra 25 basis points at this stage really kind of matters a great deal. But I think, you know, people would see it in the frame of, once again, the market is trying to get too dovish. Maybe the Fed is right. And therefore, the backdrop, which people have been hoping for 2024, might be differently. Because also as well, the Fed aren't going to start talking dovishly, you know, anytime soon. They're just not going to do it. So I think, you know, this non-farm payrolls will be important, but in terms of, you know, how you kind of trade it in this environment, as Ryan always says, even if you know the number, I think it's quite difficult, because if you take FX, for example, yes, a softer release would be dollar, you know, negative, but it depends, you know, what's going on with, you know, the Japanese yen at the time, what's going on with the euro. It's all relative. So, you know, keep an eye out. But I think, you know, a dovish release definitely carries more sway than a hawkish one.
Yeah, I would agree with that. I do just want to caveat one thing you said, which was the unemployment rate last month. You know, rightly, you say it did rise from, I think it was 3.5 to 3.8, but that was on an equal rise in the participation rate, which also hit a new cycle high. So it's not all bad news when it comes to unemployment, I don't think.
True. Yeah. No, I agree with that as well. And I'd also agree that, you know, another thing I mentioned is the wages as well. I think there's the wages, I don't really know how to read those at all at the moment, because I think, you know, you've seen all these wage agreements like the UAW where they're looking for 30-40% pay increases. I think the more we see of that, I think the wage metrics are getting increasingly, you know, kind of noisy as well. So I think basically when, you know, the first day you see this data, I think when people dig into it, I think there's going to be a lot more moving parts than there probably otherwise would. So I think it's going to be hard to know initially what to kind of do with a release.
Yeah, I'm going to steal one of Ryan's lines here and say it could be one of those fast money versus right money or correct money lines on this one as people dig
Right
into
money,
the
real
data.
money. No,
there you go.
No,
and I'm also going to...
Fast money, real money.
There you go, fast money, real money. And I'm also going to potentially... You can have a point for that. Go on. And I'm also going to potentially steal something Arno might say, which is that you mentioned the UAW strikes.
Get off my farm. Sorry, what?
Oh God! If I've got my dates right, the strikes actually started after the end of the survey week. So any impact of those layoffs, temporary people, striking on picket lines, not going to work, that will be in the October report rather than this one. So that is one downside risk eliminated. But before I steal any more of your thunder, Arno, why don't you take it away with your thoughts on the jobs number and its policy implications?
Yeah, I mean, who knows? When it comes to NFP...
That's my boy.
Well, I was hoping you would. That's kind of why I asked you the question, mate.
Let's talk about ADP first. It's one of those data points, like Adam said, everybody gets so super excited about it. ADP has a worse track record of predicting NFP than I do. And I've got a pretty bad one when it comes to NFP, so it's just such useless information. And what do we do with it on a week like this? We have jolts at 9.6 million and ADP prints 89,000. So the market's like, which one should I believe? Am I going to go with this one? Am I going to go with that one? Obviously, I do.
NFP is going to get revised the crap out of over the next few months anyway. So it's like...
Exactly. And I mean, I do agree with Adam, from a reaction perspective. I do think this NFP could really... create a lot of volatility. But the way for that to happen, we would need to see that data points coming in a very, very specific way. And what I mean by that is you don't need any type of ambiguous print like we had with the ISM manufacturing. When was it on Monday? We had prices paid coming in very, very low, but that upside surprise in the employment data. You don't want something like that when you're trying to get a good directional move out of something like NFP. What I would look for is the most bearish or the most dovish or most hawkish outcome, meaning that you want unemployment rate to come in much higher than expected, NFP to fall off a cliff, wages coming in lower. One of those prints where everything is bad. Unemployment is up.
One of them.
Say again?
When was the last time we had one of them?
4 months ago, I checked. So it doesn't happen very often. But those are the ones that you can look to trade, right? If you get anything that's mixed, you're just wasting your time. You're guessing. You're probably going to have more fun if you put it all on red or black. It's going to give you the same outcome. You're going to have the same edge. So that would probably be what I would look for if it's really, 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 really bad with all of those metrics coming in low. Some short-term dollar downside could be attractive for the day traders out there. Maybe even gold. At these levels, it does look fairly cheap. But I've seen data from Deutsche coming in. Say again.
I said I've seen it lower.
Yeah, I mean, Deutsche came in with data saying that the CPAs have just been having a field day on the short side with it. So there is risk trying to, pick a bottom with that. But that's probably the best way to look at the data. If everything comes in the opposite, everything's super great. Wages goes up, unemployment comes down, labor goes up. If it's just that perfect hawkish print, I wouldn't like to chase the dollar from there, but I would probably look at equity downside. That could be interesting, with volatility picking up a little bit. But yeah, in terms of what this data point means for the economy, absolutely nothing. I was expecting softness for the labor market to creep in 3 months ago already, and the economy just basically told me, listen, not today, pal. It's not going to happen now. Everything is still fine. So yeah, don't extrapolate anything from JOLTS or ADP or NFP. Trade them as short-term trades, if you will, but don't go betting anything big that this means anything. If we want to see a change in the recent trend, it's going to take more than one NFP print, right? We would need to see a string of data coming in negative, or a string of data starting to pose the question of maybe the Fed has overplayed their welcome. But one NFP print, it's just not gonna do it. So if you want to, trade it as a short-term trade, but it's not going to mean anything for the bigger picture.
No, exactly. And
Arno, I don't think we're going to be invited back onto shows with NFP in future.
So it's a very short list of people I have to invite on, so I think you're safe.
Thanks. Yeah, cheers.
I was just going to make one final point before we do go to the scores, and Arno, you brought it up around a trend, and you got to remember this is what policymakers base policy on. It's a trend. Is the unemployment rate rising for a certain number of months in a row, not one spike either way and then it fades the next month? Anyway, with that said and done, let's have a look at the final scores. Well, I don't think there's any surprises with this one. Ryan clearly a bit rusty after his 4-week break, and the bookie's favourite romps home once again. So well done, Adam.
Robbed.
Well, thank you all. That was great. And Ryan, I hope you get better soon with your NFP kind of rant you just had there.
Yeah, I'll get Pepperstone to fund some therapy sessions for you, mate. I'm sure.
Or it could fund a bar bill tomorrow, Thursday.
We'll leave that one up for discussion off camera. Right, let's leave things there. Thank you very much as always to the gents for joining me. Ryan Paisey from PiQ Suite, Adam Linton from Newsquawk, and Arno Venter down in South Africa. Thanks to Kyriakos as well, our producer, for bringing this together as brilliantly as he always does from about 5 or 6 different locations. Thank you very much for watching. If you enjoyed the show, drop a like, leave a comment as well. Let us know how you're trading the markets, and we'll see you again soon. Thanks again. Goodbye for now.